Even long-term investors need to know when to sell a stock. When is something just a quick blip in an otherwise good investment, and when is it a warning sign for bigger losses? In this video, I'm revealing the top 5 reasons to sell stocks used by professional fund managers. You'll not only learn how to protect your portfolio, but when to make that decision. We're talking when to sell an investment today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. We talk a lot about how to analyze stocks and when to buy here on the channel, but we haven't looked at the other side yet, how to know when to sell a stock. I'm a long-term investor and a lot of my stocks are buy and hold for decades, but that doesn't mean I can just ignore what's happening in a stock I own. There are reasons to sell a stock, even if it's something you planned on holding for the long haul. Not only will knowing when to sell a stock protect you from those big losses, it's also going to help keep your portfolio zeroed in on your goals. So let's look at 5 reasons professional fund managers look to when they sell stocks, and I guarantee you that one reason you might be thinking of isn't on the list. Our first reason to sell is when there's been a major scandal or a lawsuit against the company, but that's not going to be enough in itself. The bigger issue is when there's no change in leadership and no accountability. Now, companies make mistakes just like people. Management is under huge pressure to meet profit estimates, and sometimes they can go just a little too far. We can accept that as investors. What we can't accept is that there's no accountability, or when there's a major scandal results in just a slap on the wrist for management. Probably the best example of this is the Wells Fargo scandal around cross-selling and customer service ordering credit cards for customers that never signed up. The fraud wasn't found out until 2016, but the practice leading up to it was actually reported way back in 2011 and 2013 by the Wall Street Journal and the LA Times. So the bank knew for years that employees were being encouraged to open fake checking and savings accounts. In fact, Wells fired over 5,000 employees from 2011 to 2016 because of that practice, but all this time, no senior management was held accountable. Even after a $185 million fine in September 2016 and testifying before Congress, it wasn't clear that CEO Stumpf would be held accountable. It was only after huge public pressure that the board of directors eventually fired him. So we're not talking about selling immediately when bad news hits, but waiting a couple weeks to see management's response. The board of directors and management need to take action to restore investor confidence, and that means holding accountable the people that knew or should have known. If that doesn't happen, the poor investor sentiment is going to overhang the stock for years, and the corporate culture is just going to rot. Another reason to sell stock is when the company has gone on a major debt-fueled acquisition binge. This has been the #1 destroyer of stocks over the past decade. Since that 2008 crash, revenue growth has been about as slow as it's ever been. Profits have grown, but only because companies have cut costs and spent trillions in share buybacks. The top-line growth just hasn't been there. Combine this slow sales growth with historically low interest rates, and that prime strategy for a lot of companies has been used to use a lot of debt to buy other companies. They're basically saying they can't grow otherwise, so they'll buy it and hope the profits cover those debt payments. The problem is that these huge acquisitions make it easy to cover up poor management, and that massive debt gets out of control very fast. This is actually one of the biggest warning signs for a dividend cut as well, and part of a video we did a few months back. I revealed the 3 threats to a company's dividend and how to get out before a cut. It's a must-watch video for every dividend investor, so I'll leave a link to that in the video description below. For example, Teva fueled itself on acquiring other drug makers for years. It neglected its own drug development, and because rates were at historic lows, just refilled the pipeline by buying other companies. In 2016, it funded its $40 billion acquisition of Actavis with $25 billion in debt, just ballooning the amount it owed. Interest expense it owed each year tripled from $270 million to $875 million within a year. When generic drug makers found they couldn't keep up with the price increases and competition started eroding sales, Teva was in big trouble. Net income plunged to negative $16 billion in 2017, and there was no way out but to conserve cash by slicing the dividend. Now, checking the debt load on your stocks isn't difficult. First, you want to check out the statement of cash flows under cash flows from financing. This is going to show you if a company has been repaying debt or has added a bunch lately. Of course, if they've made any big headline acquisitions, then you can bet it was paid for with debt. Again, a lot of companies is going to think that making a big acquisition is going to fix their sales problem. They might even be losing sales, but they think that tying another boat onto their sinking ship, that's suddenly going to get them both to float. Teva had seen sales flat for 2 years and even fell by $620 million in 2015. That $40 billion acquisition helped them make another $2 billion in 2016, but at a huge cost in extra expenses and interest payments. It doesn't take a financial nerd like myself to understand that buying another company isn't going to fix your broken one. If you own shares in a company that is losing sales and management can't do anything about it, the last thing you want them to do is try covering it up by acquiring other companies. Now, the easiest way to find this is just to follow the sales growth of the stocks in your portfolio and watch for those big headline acquisitions. If a company is struggling to grow sales at a rate investors expect and is putting a lot of debt to buy other companies, that's a big warning sign to sell. Now, our third reason when you should consider selling a stock is when investors lose all faith in management. As a venture capital analyst, probably the biggest thing I watched for was management. It wasn't the product, it wasn't the market, it was whether management could make the hard decisions to grow a company. It doesn't matter if you're investing in a $25 million startup or a $25 billion large cap company. It all comes down to management. Management not only needs to effectively guide the company, but it also needs to effectively manage investor expectations. Now, that's an important point that most investors just don't understand. It's why you can get companies that are growing by double-digit earnings but still see their stock price plunge on earnings day. You see, the stock market is forward-looking. Everyone knows what's happened in the past. Investors know where earnings have been. That's no surprise. So the market builds expectations for what a company's earnings is going to be over the next year or more. That also goes into those stock prices. Now, management's job is to not only grow earnings, but also influence those expectations so there's not a huge letdown. So your third reason to sell here is actually a couple of different signals. First is when management continuously misses earnings or sales expectations. When 80% of companies beat their earnings estimates every quarter, missing on a regular basis is just unforgivable. Investors are never going to know what to expect. The shares are always going to be volatile and there will be no confidence in management. The second signal here is that a company constantly underperforms its competitors on an operating margin or other financials. Now, there might be reasons a company underperforms in 1 or 2 quarters, but management needs to be putting together a turnaround plan. Nobody wants to invest in management that's satisfied with second best. We saw this in General Electric, one of the icons of American business, and its disastrous stock plunge over the last couple of years. The company was managing to beat earnings expectations, but by smaller amounts and only by managing estimates lower continuously. We see here that the operating margin, that core measure of profitability, just got destroyed from 20% in 2010 to less than 5% in 2017. This happened as sales growth was all over the place, mostly negative and always under 5%. All while this was happening, CEO Immelt neglected any kind of a turnaround strategy or facing the hard facts. Even after Immelt stepped down in October 2017, his successors had a tough time righting the ship. Now, one reason to sell that has less to do with the company is when shares meet your price target or you just need to reallocate to other investments. Anytime you invest in a stock, you need to set a price target, what you think the fair value is for that company. It's not enough just to invest in good companies because you have to know that the stock price leaves room for the upside returns as it builds to that fair value. Like we said, the market is forward-looking, so the future earnings expectations are already built into stocks. That means a stock already trading at that fair value isn't worth much because the only way for shares to move higher are for the earnings in the future to justify it. Now, I'm not saying you should trade in and out of stocks each time the price goes up. If you're going to be investing in individual stocks, though, you need to follow the price and update your fair value estimate every year or two. If that fair value keeps rising on good fundamentals, then that's great. But if there's just not much value left in the stock, there's no reason to let it be a drag on your portfolio. Another reason here related to this is that you might need to sell a stock to avoid overexposure to a specific company or sector. For example, if your shares jump, then that company's stock could be more than 5% of your portfolio. That's kind of a cutoff I use for when a stock is just too much of my wealth, and I want to limit my exposure just in case it comes back down. Now, one of the biggest problems with selling stocks is that it doubles your investing costs. You pay a commission to buy and then another fee to sell your stocks. That's why I've started using M1 Finance for my portfolio. It's a no-fee investing site, an automated investing tool that I'm using for our 2019 Stock Market Challenge here on YouTube. Just set up your portfolio of stocks and M1 will automatically invest any cash, including reinvesting dividends into your portfolio. I'll leave a link to learn more about M1 Finance as well as a link to our 2019 Investing Challenge here in the video description below. Our fifth reason to consider selling shares is when the fundamentals of the company have changed from your initial outlook. This one takes a little more analysis than the others and maybe isn't a singular defined signal, but it's no less important. The idea is that you have 2 primary reasons for buying a stock. First, you might buy it on the price. Maybe there's a lot of upside return to that fair value, so you invest until the shares rebound like we saw with the last signal. The other reason is that the fundamentals make the company a best of breed in this space. So you've got things like profitability or other metrics that are higher than peers. Maybe a new project the company is launching could be a game changer. Whatever it is, something sets this company apart that makes it fundamentally better than its competitors. Well, that's not something that lasts forever. If those metrics start to drop or come in line with peers, or maybe competitors start their own projects and management has no second act, then you have to ask yourself if that changes the best of breed status for the company. Notice that nowhere in this list of 5 reasons to sell a stock was anything about a falling stock price. That's something that trips up a lot of investors and just guarantees losses. You see, just because a stock price is decreased doesn't make it a bad investment. There are all kinds of short-term reasons for price weakness that might not change your long-term investment reasoning. Now, if the reason if the shares are falling falls somewhere in these 5 reasons we talked about, then you'd have to revisit whether you want to hold the investment. On the other hand, if you look at the fundamentals and they still point to a solid outlook, then maybe this is actually the best time to buy more of the shares at a lower price. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in a future video.